financial indicators, historical financial indicators for Vitesse Corp. So we have about five or six classes. We have the valuation ratios, profitability ratios, the growth rate, the liquidity rate, the operation efficiency rate, the leverage ratios, and the coverage ratios, right? And each of these have their implications. I'm going to talk about that while we move in practice. Now, valuation ratios consider the value that investors place on the firm in tandem with the value they receive. So the value they receive will reflect the sentiments of the market concerning the business. So the value they place will show up in the stock prices, for instance, and then the value they receive will reflect in things like dividend payout, right, and the dividends per share, right, which would, of course, be based on the earnings. So we're going to be comparing the company's actual earnings against the company's stock prices and being able to see whether the company is earning well sufficiently for its valuation or whether the valuation justifies its earnings. And that's basically a very important measure, important metric for a business, a quoted business. And then we have earnings per share, we have dividends per share, price to earning ratio, price to book ratio, and the dividends payout ratio. Now, let's begin with earnings per share. Now, this is how much net profit is made per share. Now, if we look at the net profits or the net income, and then we divided it by the number of shares outstanding or the total number of shares, where do we have that information? 55. Also, B20 divided by B61. Then we have the stock price, earnings per share. Sorry, not over stock price, but divided by outstanding shares, the total number of outstanding shares. Then we have 2.26. So every share, if we took our earnings, our net profit, and distributed it across each of the shares we had, across each of the outstanding shares the company has put out, then we're going to have $2.26 on every share. So the company earned enough in net income to be able to provide $2.26 to $2.26 for every share. And then still the same principle, we have dividends paid, right, over the net income. Sorry, not over net income, over share. So we have dividends per share. And let's look at the definition. It will reflect what the dividends per share, the dividends paid, right, on every share. Now, dividend paid divided by the average number of shares. And if we look at this, we have the dividends, right under the income information. So these are dividends. We'll divide this by share or the total number of outstanding shares, right? And the total number of outstanding shares is 48, and that will give us what? 80. So the dividend is about 80 cents. So if we take the total dividends that we are paid out over and spread that number or divided it by the outstanding shares available, then each share gets 80 cents of dividend. That's the logic. And then we have price to earnings ratio, which is going to consider the stock price and divide it against the earnings per share. We've already divided the earnings per share. And now this tells us to what extent. Now, if earnings per share is the earning on every share, then our stock price is the price of any share, that you can see that this of every share, each and every share, you can see that this tells you how much a stock actually earns against its valuation, right? And this is one of the very important tools we use to tell whether a stock is overvalued or undervalued. Because when a stock is delivering a lot in terms of earnings, if a company is delivering a lot in terms of earnings and its projected future is still looking very healthy, and then its price to earning rate is low compared to some other companies that are not doing as much. It could tell us that that share is not at the right level of its value and is expected to appreciate. And then we have the price to book ratio, right? Which is simply, of course, by definition, the book value of shares against the price of the shares, right? So the price divided by the book value per average number of shares. So we're simply going to take B61, right, which is going to be the price, and then we're going to divide it against the total number of outstanding shares, right, or divide it against the book value, and then multiplied by the outstanding shares. So let's do that. We have the price, the share price, and then we divide it by the book value of shares. Let's see the book value of shares. It's total liabilities and equity, total shareholders' equity, and then we multiply that against the number of outstanding shares. That's the total number of outstanding shares, which is going to be 62, and then we get 6.49. And then we have dividend payout ratio. What percentage of dividend is paid out of net income, right? So the dividend paid is what percentage of the net income? Very simple. We divide it by our net income and we get it 35, right? It's 35%, right? Now, so that's dividends payout as a ratio of the total net income. So what that means is that 35% is paid out as dividend and about 65% is replowed in as retained earnings. So these are all our valuation ratios. And then we'll come into profitability ratios. Now, return on equity is very simple. It's our net income, the net income we get over the average net income divided by average equity. So we're going to take equity of year one, equity of year two, and then divide by 2, and then has a denominator, leaving the net income as our numerator. So that's return on equity. So let's look at our net income, which is our return divided by, okay, we can't do that for the first year. Let me explain why. Because 1999 has no 98 to run an average. So I have to do it from 2000 to 1 and 2 and 3. So let's look at net income. We have net income, and then we divide it against the previous year. Sorry, that's total assets. So take net income, which is 121, and then we divide it against shareholders' equities, total shareholders' equity, right? The previous one, 1999, no, sorry, shareholders' equity, not liability and equity. Sorry, I'm doing this over and over again. Net income, which is 2 divided by the previous year's shareholders' equity plus the later year's shareholders' equity, and then dividing it by 2, and then put this in brackets so I don't mess up my calculations, right? And this is our return on equity. Let me make it out in percentages. This is about 27% or 0.27. Okay, now let's see return on sales. Now, return on sales would compare sales over, or sorry, EBIT over sales, right? Both of which are, let me explain something. Now, if you're comparing an income statement item against a balance sheet item, then what we'll need to do is we'll need to take an average of the previous year and the current year. So we take an average of 2 years to reflect where the balance sheet item was at the beginning of the period and where it is at the end or the current period, right? And that's why we could not do this calculation for 1999. There was no previous year. There was no information on the starting equity, but we had information on the ending equity. So the information on the ending equity was used as starting equity for 2020, and then we took the equity for the end of this as the ending equity for 2020, and then we put that in, and we're able to get our average divided by 2. net income as the numerator, and then of course the average of the equity between 1999 and 2000 as our average equity. Now, return on sales would not need that because it requires the sales or earnings before interest and taxation, so EBIT or operating income divided by sales, right? So look at that, EBIT divided by sales, right? So we can have this from this point, earnings before interest and taxation, which is right at the income statement, and divided by sales, our top line. And this is going to be our return on sales. If I turned it into percentage, then it's about 15% as our return on sales. Well, I can actually take all of this very simply and then do a copy and push this across. And it gives me the value required. I can do the same here and then copy. Let me distribute this and then distribute this as well. Okay, same principle. Now, earnings per share growth rate. Now, what we want to do is we want to calculate how fast our earnings per share grows. So, I mean, this is important to see whether our earnings is really growing, the extent to which it's growing over the number of outstanding shares, which would even become a more interesting. It's interesting to see that your earnings growth is outpacing the number of what shares growth, your outstanding shares growth, right? Okay, now let's look at that. Earnings per share. We also we'll calculate what in C77 we'll enter the formula 66 B66 over B65, which is going to be the next period divided by the previous period minus 1, right? So let's look at earnings per share. Let's look at earnings per share. We have this next period divided by the previous period, right? And then minus 1, and that's about 14%, right? Okay, so we have the next period divided by the previous period minus 1. And then again, we would have the next period divided by the previous period minus 1. That's a negative growth rate. Sorry, I don't think I did that very well. Earnings per share, the next period divided by the previous period minus 1. Oh, I was doing that on stock price, right? Let's correct that. Earnings per share, the next period divided by the previous period minus 1. Okay, turn that into percentage. And that's 10% growth rate. It's about 14% growth rate. Then we have the next period, and then we have the next period divided by the previous period. I keep doing this. The next period, earnings per share, the next period divided by the previous period minus 1. And that will give us in percentage about 1%, 1.4%. So earnings per share grew 14% in all right. Now for earnings per share, let's get down to earnings per share growth rate. Now for earnings per share growth rate, it's going to be the next period in earning per share divided by the previous period in earning per share minus 1. And that will give us 14%. If we drag this across, then it will give us 10 and about 1%. Of course, if we took this, there's no next period, so we're not going to see we're going to see an excessive negative growth rate. So that would not apply. Then we have dividend growth rate. Let's see how well our dividends grew, right? Let's look at our dividend numbers. For our dividend numbers, which is on the income side, we have the next period in dividend divided by the previous period in dividend, then minus 1. And that will give us these numbers. Let's drag this along. This will be only 3. We can't do that for the fourth year. Turn it into percentages, and you'd see that our dividend growth happened at about very small percentage, is 1.0. And that's the dividend growth rate. We saw very small marginal percentages, not dividends per share, but dividend growth rate. Let me confirm that we are on dividends, not dividends per share. Okay, so this dividend growth rate, yet you can see it's a very marginal increase, right? So we have very minor growth on dividends, on the dividends paid out. And then we have sales growth rate about the same principle year on year. We'll take the next year's sales. We take our next year's sales divided by the previous year's sales and then subtract 1. And then we have, okay, we'll pull this out. We can't do that for the fourth year for reasons I explained. We'll turn this into percentages, and then let's increase our decimals. Let's set our decimals to 1 or 2, right? And then we have 1.4, right? And then this is the rate of growth. So the company grows on an average of, let's say, we can create an average for this, but so far we can see that the growth rate was 1.4 and then 3.9 and then 2.6 with the year 2000 recording the greatest growth rate. And then we have EBIT growth rate, right, which will be the next period in EBIT compared against the previous period. So let's look at that. Earnings per interest and taxation, EBIT the next period divided by the previous period minus 1. And then we have EBIT growth rate. We'll pull this across. We can't do for the final year, of course, because it will be okay. So let's take this off, right? Now you can see that even though our sales were growing pretty small, our earnings before interest, right? Our earnings before interest and taxation was reducing. There was no negative growth, but then again, it initially had a very high growth, and then it reduced, and then further reduced. And let's look at the growth in net income, the next period's net income, compared against the initial period's net income. So let's look at net income. Net income's next period net income compared against the previous period's net income minus 1. And then we have this. When we drag this out, turn this into percentages, then this is the extent to which we grew. Net income grew pretty much very high in the 1999 period, reduced in the 2000 period, and in 2001, it's pretty much 0.1 as the rate. Now, for earnings per share growth rate is going to be the current period over the previous period, right? So we're taking our current period, comparing it against the previous period, right? So let's look at that, the growth rate in earnings per share. Earnings per share, current period, divided by the previous period, minus 1. Good, 14%, and then we pull this across. Okay, now dividend growth rate would be about the same thing. The dividends paid, or yes, the dividends paid out, which will be our current period. The current period divided by the previous period minus 1. And then we pull this across. And then we have sales growth rate, which will be our sales current period divided by the previous period minus 1. Of course, you can see that we cannot do for the 1999 year because we have only a current period. We do not have a previous period of 1998, right? So that value is not given, so we can only calculate based on what we have been given. And then we have earnings per share or EBIT growth rate, where we'll have earnings before interest and taxation. Earnings before interest and taxation. That's the income statement, the current period divided by the previous period minus 1. You shall have that on the right side. Good. 10.7. We pull this across. And then we have finally net income growth rate, the current period. Net income growth rate, we have the current period divided by the previous period minus 1. And that gives us 12%. So these were our growth rates for each of these years. In 2000, you can see the net income grew by 12%, right? And then in 2001, it grew by 8%. And then in 2002, it stalled. Net income growth stalled. Sales, however, increased, right? So sales increased from 1.4 to 3.9%, which was the best year in 2001, and then reduced in 2000 in 2002 to 2.6, right? There doesn't seem to be either sales, EBIT, or net income JWOs. There seem to be a decrease or a decline in the key ratios like sales growth rate, in the key growth rate figures like sales growth rate, EBIT growth rate, and net income growth rate. And you can, of course, see how it affects dividends and earnings per share. So these are our values for growth rates. Now let's look at liquidity ratios. Now, liquidity ratio tells us how much liquid, how quickly can we call on cash should we require it. That's the question liquidity ratio answers. Well, there's current ratio, there's quick ratio, there is cash ratio, and then there is so there's current ratio, there's quick ratio, and cash ratio. And these are the ones that are mostly used. But for this, we're going to use both current and quick ratio. Now, current ratio is simply our total current asset of our total current liabilities. We don't need to do an average because both of them will be taken from the balance sheet. So we'll say the current ratio over quick ratio. So total current assets over, I think I positioned this at the wrong place. I can do this from 1999. Total current asset over total current liability. As our total current liabilities is this. Okay, so we have 1.2, which is not exactly bad. I'm going to turn this into the right decimal places after I'm done. Right, so you can see our current ratio seems to increase or improve up until the third and the fourth year, where we saw it pretty much stalled. Again, what this means is that we have $1.2 of assets, of current asset for every $1 of current liabilities. And what that means is that we can be able to, if all our current liabilities were called up immediately, we would have an excess, right, at a ratio of what? $1.2 for every $1, $1.2 of assets for every $1 of current liability that is called up. So these are current. So current assets over current liabilities. Let me confirm that this is what we did. Total current liabilities against total current assets. So that's good. We did the right thing. So we can pull that across. We have quick ratios. Now, quick ratios, we take current ratio and then we subtract. So there are two ways people can do quick ratio. Now we can do quick ratios to be total current asset less inventory. You can have total current asset less inventory, right? Or another way you can do it for a more accurate count will be cash and marketable security plus receivables. So that way we do not include inventory and any other kind of current assets. So what we're going to use is cash and marketable security plus accounts receivable, and we'll divide that by total current liability. So let's do, go to the assets page. We have what? Put it in brackets, and then we'll have, with respect to assets, we'll have cash, marketable security plus accounts receivable. We don't add inventory. Now, the two ways we could have total current asset less inventory, but you can see that we have other current assets and it will factor in if we use this method. So it's better to do this and this for a more accurate count and divide by total liability, or sorry, by current liability, and this is what we have, right? Cash marketable divided by current liabilities, and then we have 0.4. Well, this can tell us quite a lot. It tells us almost probably that we have a lot of, actually, it's pretty much a significant drop, right? It means that inventory takes a very huge portion. Inventory and other current assets takes a very huge portion of our liquidity, right? They take a very huge portion of our current assets, because when they were reduced, you can see the significant drop from 1.2 to 0.4 as our quick ratio. So meaning that pure cash ratio would be around 1.1, 1.2, or 0.1, or maybe 0.2 if we're to do a cash ratio, just cash and marketable security, right? It could also mean that this company might need to improve its liquidity, right? But that's subject for another period. Now let's consider inventory turnover ratio. Now, inventory turnover ratio is simply looking at how long does it take for us to close out inventory. So if we purchase inventory to be able to do business, how long does it take for us to finish out that much inventory, enough to go out into the market to get some more inventory, to contact the supplier to get some more inventory. Now, if inventory turn is slow, it could mean a lot of things, like inefficient operations. That's why you have that under operating efficiency ratios, right? So you're going to take your cost of sales and you will divide by inventories. Now, we want to do this from year 1, year 2, year 3, year 4, but another way you could do this is, again, cost of sales divided by average inventory, because cost of sales is an income statement item. When compared against a balance sheet item, you could, of course, take an average, right? But want to do an inventory turn using just the values of the year. So we'll take cost of sales, which is B7, and divide it by B29, which is inventory, right? So let's look for cost of sales. Cost of sales, which is this, and divide it, which is B7, and we divide that by B29, which is inventory, right? And then we have this as our inventory turn. And then we have receivable turn, which would be how long does it take for us to clear out receivables that have been placed out. So if people come to buy our goods and services and they don't pay in cash immediately, then they are converted to receivable. How long does it take? How many times do we turn in a year? How many times do we clear out receivables that has been put out? In other words, receivables is not cash, it's a current asset, but we need to collect. So how soon do we collect our receivables? How many times do we clear out receivables? The formula is, of course, going to be receivables divided by, sales divided, or really credit sales divided by receivables, right? But in this case, we're going to just assume that it's going to be sales divided by receivables, because we do not really have the actual credit sales. We're just going to assume that it's going to be total sales, right? So we have sales divided by receivables. So yeah, we have sales and then we divide that by receivables, count receivables, and then we have 12. Oh, wow, good. So you can see that we turn over receivables. So the fastest thing we turn around is receivables, right? Our receivables turn is greater. We close out every receivable almost every month, because you can see in 12 months, if we are turning receivables in 12 months, then that means every receivable is converted to cash over a period of 1 month, an average of 1 month plus, right? With the poorest performance in the 2002, right, where we turned over 11.1 times, right? We've generally been 12.4, 12.1, which is good. For inventory turn, you can see that we are generally between 6 to 5.7, 5.9. What that means is that every inventory that we put into the business takes an average of 2 months, right? Because they will turn about 6 times. So let's say 6 times in a year. So that means on average 2 months in a year, every inventory that we take in gets what? Sold out, gets taken out of the gets taken out, converted to finished goods and sold, right? So that's our receivables. That's our inventory turn, and that's our receivables turn. And these are not bad figures, but then again, you don't want to run ratios in vacuum. You want to make sure that you are comparing. And I'm going to talk about how you compare very briefly. When you do ratios, before we go into leverage ratios and coverage ratios, when you do ratios, to be able to make sure that you are where the relative position, because these numbers don't mean anything if we don't compare them against the context, right? And there are 4 contexts to look out for. I call them ahead, behind, to the left, and to the right. Ahead, we're talking about your pro forma goals. So when you or your pro forma objectives, so when you compare your financial ratios, you want to compare against your pro forma objective, which is what you set out to achieve this year, right? Those are your pro forma. It's in the future, and when you achieve it, when you get to the end of the year, your actual, you want to compare against what your forecast or what your plan was, to be able to see how well you performed against the plan, right? Now, apart from ahead of you, behind you, you have what? Your past year, which is where you compare against past trend, right? Now, so if you're progressing against your objective, but then even if you didn't progress against very close to your objectives, did you do better than last year's ratio, right? So like you can see in this case, we don't have information on what their pro forma objectives were, but we can see that receivables turn was improving against last year, right? Or sorry, was not improving it over against the last year when we look at the receivable turn. Inventory turn generally did not improve over 4 years, right? It actually reduced the efficiency reduced. Inventory turnover has an efficiency ratio reduced. Of course, the higher the number, all things being equal, the better. You also compare against the industry average ratios, and then, of course, the best standard or the best in class. So the best performing company, right? You compare against the average, see whether you beat the average, you compare against the best, see how well you measure against the best. So these are the 4 key ways you want to compare your ratios to be able to have a complete perspective. And then we have, almost at the end of this, we have total debt to total capitalization, right? So we have total capitalization being a combination of short-term debt, long-term debt, and shareholders' equity, right? So total debt to total capitalization will be a combination of your short-term debt, long-term debt, your total debt, short-term and long-term debt divided by your short-term debt, long-term debt, and shareholders' equity, right? So let's do that. Total capitalization would be, we'll take our short-term debt plus long-term debt divided by short-term debt plus long-term debt plus shareholders' equity. That's our total capitalization. You can see that debt holds about 33% of our total capitalization. In the first year, we are actually leveraged by 1/3, and you can see that debt becomes a smaller percentage, slightly smaller in the subsequent year. And then we could also have total long-term debts as a measure of total capitalization. So we're not considering short-term debts now. So how much long-term debt do we have as a measure of total capitalization? So let's take long-term debt divided by total capitalization, short-term debt plus long-term debt plus total equity, total shareholders' equity. And we have 26%. And these are our values. And then we have total debt to equity, right? And then total debt to shareholders' equity. Total shareholders' equity would have what? Short-term plus long-term debt over total shareholders' equity. So we have short-term debt plus long-term debt divided by total shareholders' equity. So shareholders' equity, and then we have 4.9. Now, all of these will be expressed as percentages. And then I would prefer to have my percentages in 2 decimal places. That's just how I like to see them. Could be up to you to do it how you want to do it. Well, these turnover ratios generally are just numbers, but we just knock them off to 2 decimal places. Preferable not to put in these ratios as percentages. So this is 6 times, this is 12 times, this is 6, 12, it's 5 against 12, and 5.7 against 11 times that the turnover happened. And for our ratios, right, we also generally would tend to, current ratio generally tends to put them as, as ratios, usually expressed as ratios rather than percentages, right? And then current ratio, which is 1.2 to 1, which is 0.4 to 1. That's the ratio. And then for the rest, I think growth rates usually expressed as, okay, I'm just setting it up to 2 decimal places, which is how I'm more comfortable with my numbers. Return on sales as percentages. You might want to make it 2 decimal places. And in percentages, we have percentages and make it 2 decimal places. And then we have earnings per share. They're basically numbers, but payout ratios can be in percentages. Just make it 2 decimal places. Price to book ratio, dividends per share. Okay, the amount of dollar value on every dividend. So I think we have done that. Let's do the last one, which is going to be, of course, our coverage ratio. Now, times interest earned is measuring the amount of times our earnings before interest and taxation can be able to cover our interest expense, right? So we have times interest earned, we'll take our earnings before interest and tax, which is EBIT, and we'll divide by the interest expense for the year, both of them being income statement items. We'll take our EBIT and divide by our interest expense. Let's see what our interest expense is. Interest expense is 11. And then what we have is other net income. I'm sorry. Interest expense. We have EBIT divided by interest expense. So let's take our EBIT value, which is 180, and then we divide it by interest expense. Interest expense, which is 16. Okay, so we have that interest expense. Okay, so this is good. It shows that we can cover our interest expense 11 times in the 1999, 13 times, 10 times. So it means that we probably are getting more leveraged, or our EBIT, our earnings before interest and tax, is suffering. So you can see our position is not actually improving over 4 years. So, I mean, seriously, this company did very well in 1999, and you can almost see a progressive decline in almost every indicator over a period of 4 years, right? And then, of course, we have cash coverage ratio. Now, cash coverage ratio is considering it's almost like the time interest end. It's just that if we consider the total cash that can be used to salvage the situation, if we consider the fact that depreciation expense is a non-cash expense, so it will attempt to add it back so that we'll see how much our cash can cover for this. So it's going to be EBIT plus depreciation, earnings before interest and taxation, plus depreciation expense, which is 47, divided by interest expense, divided by our interest expense. This is our interest expense. That's on our income statement. 16 again. Divided by interest expense, which will be this. All right, okay. So B13 over B11, B13, which is EBIT, plus B11, which is depreciation expense, which is non-cash. So our EBIT is our operating profit plus depreciation, which is not a real expense, is not a real, it's an operating expense, of course, but it doesn't take cash away, right, from the business, right? And this is the reason why it's added back into the cash flow statement, right? And then when we divide this, we have 14. So that has improved our position. But when we take it across, we can, of course, see that the progressive decline still happens, right? With a slight improvement in 2020 and a degeneration in the 2 years that follow. Now, since these are not percentages, but pretty much ratio, number of times the debts can be covered, right? Then we would keep this in numbers and just reduce it to 2 decimal places. So these are our financial indicators, and been able to do a very, very quick rough consideration or evaluation of the firm's health indicators across 5 areas, where coverage ratio considers how well the company can be able to pay out its debt or cover its debts from its earnings. So times interest earned, we consider the earnings, operating earnings, and then the cash coverage ratio, we consider the operating earnings and depreciation. Leverage ratios is just letting us know how much debt we have on our total capital structure, right? You can see that we don't have a lot of debt. This is the total debt, long-term and short-term debt. This is only long-term debt on the total capital structure. And then this is going to be our total debt to equity ratio. And then, so the total debt as a proportion of just equity, you can see is 49%, right? And then we have we could have this as okay, yeah. And then we have turnover ratios, which is, like I said, is the amount of times that we can be able to turn over our inventory, right? Where inventory that is received is turned into cost of sales when sold. And the receivables is going to be the amount of times we can get back our receivables in a year. So both of them are computed over a year. The number of times we can get back our receivables from our debtors, right? From our receivable accounts, how much times we close out our receivable accounts when goods are converted into receivables after sales. We have these two measuring how much liquidity we have in the business, right? We're considering things like our current assets and then what's our current ratio, which is the amount of current asset to current liability, and our quick ratio, which is the amount of cash and marketable securities and accounts receivable to the total liabilities. And then, of course, we have our growth rates, right, for sales, dividends, EBIT, net income, profitability, which is going to be our return on equity, right? I would have loved to see things like return on asset, would have loved to add things like return on asset, but you can go ahead and calculate that, right? Return on capital employed and all of these, you can go ahead and calculate that, right? And then, of course, we have valuation ratios. And this brings us to the end of the class for today, right? And thank you very much for being with us through this period. We're going to take this further to be able to forecast. We've been able to critically look at the past by creating the three income model or the three financial statement model. We've also gone beyond that to be able to do common size ratios, right? We did common size ratios on our income statement and our balance sheet. And now we've been able to do the financial indicator historical. Now we've closed out. The next thing we want to do is projected. So we'll now get into the next level, which will be forecast. And I hope you enjoy it as much as you have enjoyed this part. Thank you very much for being with us. And then I'll see you in the next video. Bye for now.